Because oil crossed $100 and stayed there, the Federal Reserve's next move is no longer assumed to be a cut. For the first time in this cycle, futures markets are pricing a rate hike as more probable than a cut over the next 3 months. That inversion is what sent the Dow into official correction territory this week, down more than 10% from its peak. The mechanism is straightforward. Brent crude hitting $111, driven by Hormuz shipping disruption from the Iran conflict, feeds directly into consumer price forecasts, which in turn forces bond markets to reprice inflation risk. The 10-year Treasury yield has climbed 51 basis points since the conflict began, now sitting at 4.47%, its highest level this year. When the risk-free rate moves that fast, equity valuations compress across the board, and cap-weighted indexes like the S&P 500 and NASDAQ absorb the blow disproportionately. All 3 major indexes are down roughly 7% for the month of March alone. The Atlanta Fed's market probability tracker shows rate cut probability has collapsed from 60% in early February to just 16% today, while rate hike odds have climbed from single digits to 15%. Yardeni research has raised the probability of a 1970-style stagflation scenario to 35%, up from 20%. The counter scenario worth watching: if ceasefire talks Trump described as going well produce a tangible result, oil could reverse sharply, and with it, the entire rate repricing that is currently driving the sell-off. Into that environment steps Kevin Warsh, Trump's nominee to chair the Federal Reserve, and his situation is more constrained than his public confidence suggests. Warsh has staked his tenure on regime change at the Fed, sharply lower rates, a smaller balance sheet, restructured communication, and Trump has explicitly demanded rate cuts. But markets are currently pricing no cut for at least the next 16 months, with the 2-year Treasury trading near 4%, a signal that the institutional machinery Warsh wants to overhaul is already telling him the opposite of what he wants to hear. The specific bind is this: $100 oil creates inflation pressure that, by the Fed's own framework, argues for holding or hiking, yet Warsh's entire mandate from Trump is to cut. That contradiction means his first move as chair could be forced upon him by energy markets before he even installs new models or changes communication strategy. Governor Barr has publicly noted that Warsh will walk into an energy shock on day one. Even his Senate confirmation is uncertain. Senator Tillis has threatened to hold the vote pending a DOJ probe into the current chair. If oil retreats below $90, Warsh gains room to maneuver and could credibly begin a cut cycle. If oil holds above $100, his reform agenda becomes hostage to an inflation constraint he cannot talk away. Meanwhile, a different kind of credibility problem is eroding confidence in the largest technology companies. Not operational failure, but the widening gap between AI investment scale and investor patience for returns. Microsoft is down 24% year-to-date while spending $30 billion per quarter on AI infrastructure, making it the worst-performing Magnificent Seven stock. Meta is on track to decline more than 12% for the week after losing a landmark platform addiction lawsuit and announcing it will continue heavy AI spending regardless. Amazon is down 3% Friday on a combination of macro pressure and questions about whether AWS growth can justify the capital deployment rate. The mechanism here is not that AI spending is wrong, it is that markets are beginning to discount the timeline for monetization. When a company like Microsoft posts its worst quarterly performance since 2008 in the same period it announces a Texas data center expansion, it signals to investors that the payoff horizon is longer than originally priced. Meta's situation adds legal risk on top of that. The platform addiction ruling introduces a structural liability that complicates the AI narrative. The forward pressure point is Q2 earnings season, when investors will demand to see whether AI spending is converting into measurable revenue acceleration. If it doesn't, the repricing for big tech has further to run.
Feeding directly into that AI anxiety is a sector-level shock that hit cybersecurity stocks Friday, a leaked preview of Anthropic's new model, Claude Mythos, designed specifically for cybersecurity applications. Palo Alto Networks fell 6% to $146, and Okta dropped 7% to $73.50, both running well ahead of the S&P 500's 1% decline. The mechanism investors are pricing: if an AI-native model can automate threat detection and response at the scale Anthropic suggests, it commoditizes the core product that established platforms charge premium prices to deliver. Palo Alto has built a $6.3 billion next-generation security ARR on platformization, a bundled strategy explicitly designed to resist point solution competition. Okta has repositioned itself as the identity layer for AI agents. Neither positioning offers clear protection against a model that operates at the infrastructure layer rather than the product layer. CrowdStrike fell 6% on the same concerns. The sell-off is happening on a leak, not a product launch, which makes it either a significant overreaction or evidence that the market is finally pricing structural disruption risk into a sector that has traded on premium multiples for years. The resolution point: if Claude Mythos launches and enterprise adoption is slow, these stocks recover quickly. If it gains traction with the same cloud-native buyers that Palo Alto and Okta serve, the re-rating has structural depth. Underneath the macro turbulence, one company is executing a thesis that remains intact regardless of oil prices or ceasefire timelines. Micron has begun mass production of HBM4, the next generation of high-bandwidth memory, specifically for NVIDIA's Vera Rubin GPU, the successor to Blackwell. In its most recent quarter, Micron reported 56% year-over-year revenue growth to $13.64 billion, with its cloud memory business unit, the HBM segment, posting revenue that nearly doubled to $5.28 billion at a 66% gross margin. Guidance for the next quarter came in at $18.7 billion, implying sequential growth of roughly 37%. The structural mechanism is supply scarcity. SK Hynix chairman has publicly stated the memory shortage will not resolve until 2030. With Micron as the only US-based producer in a market dominated by Samsung and SK Hynix, it carries additional strategic value as AI data center build-out accelerates domestically. The complication is valuation timing. Shares had already run 62% into earnings, and the stock sold off 4% on the day of its record report, a classic buy the rumor dynamic. Geopolitical concerns about helium supply for chip manufacturing, relevant to Middle East conflict, added pressure. If demand from NVIDIA's Vera Rubin ramp hits its production timeline and HBM pricing holds, Micron's forward earnings trajectory makes the current price defensible. If the AI capex cycle slows, precisely what investors fear about Microsoft and Meta, the memory supercycle thesis faces its hardest test. Across all 5 of these dynamics, the watch points for the week ahead are, first, whether oil sustains above 105 or retreats below 100. The $100 level is the dividing line between energy shock and manageable inflation, and every other market call flows from that. Second, whether Trump's ceasefire language produces a concrete diplomatic event before Monday open, which would be the most powerful single catalyst for a market reversal. Third, what the next round of big tech commentary reveals about AI revenue conversion. If any Magnificent Seven CEO uses an earnings call or public appearance to quantify AI monetization in concrete terms, it can arrest the confidence erosion before Q2 results formally land.